Following a period of continuous strength in global growth since late 2016, most recent indicators suggest that global economic momentum, although still strong, is showing some signs of moderation. High-frequency global indicators such as Monthly Purchasing Managers Index, PMI, and export volumes have recorded a more moderate expansion in recent months. This is evidenced by the mixed second quarter 2018 GDP outturns across the world, showing that global growth has started to be less synchronized. While US growth continued to accelerate, major economies such as the Euro area and regional peers including China, the Philippines and Singapore recorded slower growth in the second quarter compared to the first quarter. Turning to Malaysia, the second quarter of 2018 was an eventful quarter. For some, it will be remembered for the 14th general election, the beginning of a one-off tax holiday, and significant improvement in consumer and business sentiments. Although the headlines may have been dominated by these topics, the economy in the second quarter of 2018 also faced supply shocks that affected production in both the mining and agricultural sectors. The Malaysian economy registered a slower growth of 4.5% in the second quarter. This mainly reflects sector-specific shocks that weigh down growth in both the agriculture and mining sectors. The mining sector was affected by the natural gas supply disruptions, while the agriculture sector was weighed down by a sharp decline in palm oil and rubber production. Nevertheless, the services and manufacturing sectors, which account for about 80% of GDP, continued to support growth. The services sector was driven mainly by growth in the wholesale and retail trade subsector, while the manufacturing sector growth was supported by continued growth in the E&E and consumer-related clusters. On the demand side, growth was weighed down by lower net exports and public investment. The weakness in the mining and agriculture sectors contribute to a moderation in exports. At the same time, public investment registered a contraction as some of the large projects like Rapid, Petronas Train 9 LNG facility neared the tail end of construction. Federal government development expenditure also contracted during the quarter, further weighing on public investment growth. In June, federal government development expenditure contracted by 28.7%. However, private sector activity continued to anchor growth. Household spending was supported by favorable income and employment conditions, with an additional impetus from the tax holiday. Firms continued to invest amid improving business sentiment and higher capacity utilization in the quarter. Private consumption grew strongly by 8%, driven by continued private sector wage growth and significant improvement in consumer sentiments. The zero rating of GST since June lent further support to household spending. Going forward, private consumption will benefit from favorable labour market conditions with additional impetus from higher spending due to the tax holiday. Private investment expanded at a faster pace of 6.1%, which reflects a significant rebound from the underperformance in the first quarter. The better performance was supported by favorable demand conditions amid continued high capacity utilization. Looking ahead, investment activity is expected to be supported by ongoing projects in both the export-oriented, for example the E&E and primary-related manufacturing subsectors, and domestic-oriented sectors, for example the transport and utilities services subsectors. Gross exports expanded at 8.2%, supported by continued demand from Malaysia's major trade partners. Domestic exports, which measures exports of locally produced goods, turned around to register a marginal positive growth of 0.2%. Gross imports rebounded to register a positive growth of 7.7%, underpinned by robust re-export activity and recovery in capital imports amid stronger domestic investment activity. Going forward, Malaysia's export performance is expected to remain firm. This is supported by continued demand from major trade partners and expansion in the global technology cycle, as well as increased domestic production capacity. The ringgit depreciated against the US dollar in the second quarter and has depreciated by 0.9% against the US dollar this year until 16 August 2018. This was driven mainly by external developments, namely expectations for a faster pace of normalization in the US, escalating trade tensions, and contagion from Turkey to other emerging markets. The ringgit depreciation in 2018 was in line with regional currencies, while other regional currencies has depreciated between 1.8 to 8.8%. The ringgit has depreciated by 0.9% against the US dollar. Despite non-resident portfolio outflows in the second quarter, financial conditions remain stable and generally in line with regional countries. The domestic bond remained resilient during the period, supported by domestic institutional investors. The KLCI declined by 9.2% during the period, in line with regional trend amid uncertainties on the pace of monetary policy normalization in the US and rising trade tensions. CLIBOR and FD rates also remain stable in the second quarter. Despite the strong macroeconomic performance in recent years, of late, there have been some reservations that the high GDP growth has not translated into improvements in the overall well-being of Malaysians. This article seeks to explain what appears to be a disconnect between Malaysia's strong headline economic figures and sentiments on the ground. Several factors may have contributed to this divergence, including first, the level of income is low and unevenly distributed, significantly affecting household economic well-being. Second, the effects of higher cost of living, particularly on lower income households. Third, high debt obligations coupled with deteriorating housing affordability. And finally, households' worsening perception of corruption and governance, which fuel skepticism over the strength of the Malaysian economy. For policymakers, apart from focusing on macro headline figures such as GDP and inflation, there needs to be more attention on the distributional aspects of growth, with sharper focus on the quality of jobs created, cost of living, and housing affordability. The economy registered a slower growth of 4.5% in the second quarter on account of production shocks in mining and agriculture. Other sectors continued to register firm growth performance amid sustained demand from the private and external sectors. As a result, Malaysia is expected to remain on a steady growth path in 2018 and 2019, supported by strong macroeconomic fundamentals and sufficient buffers to weather domestic and external shocks. The growth performance and the fact that our economic fundamentals remain sound provide a window of opportunity for the country to embark on deep reforms that will put Malaysia Baru on solid economic footing.